To kick things off today, the IRS collected over $15 billion in estimated tax penalties last year.
Wow. Just in penalties.
Literally just in penalties. Not income tax, not capital gains. Just $15 billion from people who, misunderstood the math or maybe just missed the timing of their tax liabilities.
That is a staggering amount of unforced errors.
Right. And it really highlights that for high earners, whether you're a doctor, a tech worker, maybe a platinum-selling rapper, making the money is really just the opening sequence.
Yeah, keeping it from evaporating is the actual game because it's a completely different rule book once you cross certain income thresholds.
Exactly. So today's deep dive is all about that rule book, the ultimate playbook the wealthy use to legally reduce their tax burden, sometimes like all the way down to zero.
Which sounds fake, but it's entirely structural. We're synthesizing a really dense stack of sources today. We've got aggressive real estate wealth strategies, a really rigorous crowdsourced playbook from Reddit for Henrys.
Oh, high earners, not rich yet.
Right, the Henrys. And we're pairing that with specialized tax planning tactics from a CPA and a wealth manager who deal specifically with physicians.
So whether you are prepping for a massive career leap, trying to optimize a side hustle, or just insanely curious about how billionaires pay less in taxes than their assistants, this is your shortcut.
Yeah, it's a look under the hood.
So let's jump right into the baseline. Section 1 is what the sources call building the fortress. Because you don't start doing flashy tax-erasing loopholes if your defense is weak.
No, absolutely not. You can't play high-stakes tax games if a single lawsuit or a medical emergency can just wipe you out. It starts with liquidity.
Right, the emergency fund upgrade.
Yeah, because the days of leaving $50,000 or $100,000 in a standard checking account earning 3.01% are completely over.
It's basically losing money to inflation every single day.
Exactly. The playbook dictates moving 3 to 6 months of expenses into vehicles that actually yield something but remain fully liquid. A lot of high earners are utilizing Treasury ETFs for this.
Like the one trading under the ticker symbol SGOV, right?
Yeah, SGOV is a prime example.
Let's unpack the mechanism there, though. Because, people hear the word bonds, and they immediately assume their money is locked up for a decade.
Right, which isn't the case here. SGOV holds ultra short-term government debt. We're talking 1 to 3 months to maturity.
Okay.
Because the duration is so short, the share price barely fluctuates. But it pays out a yield like around 5% right now every single month.
And there's a specific tax advantage there, too, isn't there?
It's a huge advantage. The interest from U.S. Treasuries is exempt from state and local income taxes.
Oh, wow. So if you live in a high-tax state like California or New York, that state tax exemption creates a much higher effective yield than just a standard high-yield savings account.
Precisely. It's just an easy mathematical win. But the other half of that fortress is liability protection.
The insurance lab.
Yeah. High earners are targets. They have a massive target on their back, so they need specific shields. The sources emphasize term life insurance first. And they explicitly say to avoid high-premium whole life policies.
Right. Stick to term. And they recommend a laddered approach, which, to use an analogy, it's basically like building a massive, unbreachable moat around your castle before you even start hoarding treasure inside.
That's a great way to look at it. The laddering makes a lot of sense mathematically. You don't need a massive policy forever, right? You need it when your liabilities are at their absolute peak.
So how does the ladder actually work in practice?
So you buy a 30-year policy for, say, $1 million to cover the baseline, but then you stack a secondary 20-year policy for maybe $500K right on top of it.
Ah, to cover that super expensive window where you have a massive mortgage and kids to put through college.
Exactly. And when the kids graduate and the house is paid off, that second policy just drops off and your premiums drop right along with it.
It matches your coverage directly to your liability curve. That's incredibly efficient.
And for specialized high earners, think like a neurosurgeon or a highly specialized engineer, the sources highlight the absolute necessity of own occupation disability insurance.
Wait, own occupation. The wording of the contract is the entire mechanism there, right?
It's the only thing that matters.
Because if a surgeon damages their hands in, like a ski accident, a generic disability policy could argue that they're still physically capable of, teaching biology at a community college.
Right, and they'll deny the payout based on that. An own occupation definition specifically ensures your ability to perform your highly specialized, high-income skill.
So if you can't do surgery, you get paid, period.
Exactly. Without it, your earning power is entirely exposed. And you cap off that defense with an umbrella insurance policy.
Because auto insurance limits cap out.
Yeah, say your auto policy maxes out at $500,000. If you get sued for $2 million after a bad car accident, you are personally on the hook for that remaining $1.5 million.
Which would instantly drain everything we just talked about protecting.
Exactly. An umbrella policy sits on top of your primary insurance. It bridges that gap. And securing a $1 or $2 million umbrella policy is surprisingly cheap. It's often just $200 to $400 a year.
Okay, so the moat is dug, the firewall is up, the downside is capped. Now the sources pivot to the offense.
The stealth wealth vehicles.
Yes, hacking tax-advantaged accounts. And the absolute holy grail in this stack of documents is the health savings account, specifically a trick they call receipt hoarding.
This is wild. The HSA is the only account in the U.S. tax code that is triple tax advantaged.
Tax deductible going in, tax-free growth, tax-free coming out.
Right, but high earners, they don't actually use the HSA to pay for medical bills today.
They treat it as a pure, untouchable investment vehicle.
Exactly. Let's walk through the math. You get a $2,000 medical bill. You have the money in your HSA, but you don't touch it. You pay the $2,000 out of your regular cash flow.
Out of pocket.
Out of pocket.
Yeah.
And you leave that $2,000 inside the HSA, usually invested in something like an S&P 500 index fund. And here's the trick. You save the medical receipt.
Okay, I see where this is going.
Fast forward 20 years. That initial $2,000 investment compounds and grows to, say, $8,000. The IRS currently has no time limit on when you can reimburse yourself for a past medical expense.
Wait, really? No time limit at all?
None. So you present that 20-year-old receipt to the administrator. You withdraw your original $2,000 plus the $6,000 in growth, completely tax-free.
Okay, hold on. I have to push back on the logistics of this. You're telling me people are literally saving decades-old medical receipts in a shoebox just to hack the tax code later. I mean, a faded piece of thermal paper from a CVS in 2014 isn't going to hold up in an audit in 2035. Is this actually worth the administrative headache?
A shoebox won't work, no. It requires absolute meticulous administrative hygiene. The playbook assumes you are instantly digitizing these receipts into a secure cloud folder.
Yeah.
Categorized by year alongside the matching explanation of benefits. If you don't have the discipline to maintain the digital paper trail, yeah, the strategy collapses under an audit.
Fair enough. Now, the HSA is great, but it's capped at a few $1,000s a year. W-2 high earners, especially tech workers at places like Amazon, Google, Meta, they need to shelter much larger sums.
Right. The standard 401k limit is just $23,500.
But the sources outline this mechanism called the Mega Backdoor Roth, where you can stuff up to $69,000 a year into a tax-advantaged account. How does that even work?
So this is highly dependent on how your specific employer structures their 401k plan. You hit your standard $23,500 limit, you get your employer match, then the mechanism relies on your plan allowing after-tax, non-Roth contributions.
Which means you're putting in money that has already been taxed, but it's sitting in a traditional bucket where the future growth would be taxed as income. That sounds like a terrible deal.
It is a terrible deal, unless the plan also allows for an in-plan conversion.
Okay, what's that?
The moment that after-tax money hits the account, you immediately convert it into the Roth bucket. Because you already paid taxes on the seed money and it hasn't had time to generate gains, the conversion itself triggers no new tax. But from that moment forward, all the future growth is permanently sheltered from taxes.
So it's literally just a momentary staging area to get the funds reclassified as Roth. That's brilliant. But what if you don't work in big tech? Say you're a high-earning W-2 physician or a business owner.
Then you look at a cash balance plan. This is a CPA secret weapon.
The sources describe this as a way to just, poof, delete hundreds of thousands of dollars from your taxable income.
Yeah, it acts like a personal pension. You hire an actuary and they calculate a target retirement payout based on your age and income.
Right.
To fund that payout, the actuary dictates exactly how much you must contribute this year. And because the limits are age-dependent, an older high earner might drop $100,000 to $300,000 into the plan in a single year.
And that entire contribution is just deducted from their taxable income instantly.
Instantly. It's a massive upfront deduction.
Wow. Okay, so we've maxed the sheltered accounts. The next section of the deep dive covers the investment engine, optimizing the liquid capital that's left over.
Right. Allocating between debt, stocks, and company equity.
The sources have a very clear 5% rule for debt. Basically, if you have debt with an interest rate over 10%, you drain your savings to destroy it immediately.
Because you just can't consistently beat a guaranteed 10% or 15% return in the market.
Exactly. But if the debt is around 5 or 6%, like a mortgage, you stretch it out, maintain liquidity, and make the regular payments. But I want to talk about the mortgage math, because people always say, oh, prepay the mortgage to get the tax write-off.
That is a huge misconception for most people now.
Right, because of the standard deduction. For a married couple, the standard deduction is, what, around $31,500 right now?
Yes. And you only benefit from the mortgage interest deduction if your total itemizations exceed that 31.5K threshold.
So if your state taxes are capped at 10K and your mortgage interest is only 15K, that's only 25K total. You're better off just taking the standard deduction anyway.
Exactly. Prepaying a low-interest mortgage in that scenario just ties up your liquidity for literally zero tax advantage.
It makes no sense. So once debt is optimized, the capital flows into the market. And the Henry playbook is dogmatic about this. Stick to broad index funds like VTI or VOO.
They want that historical 8 to 10% return.
Because concentration risk-picking individual stocks is so dangerous. It's kind of like microwaving a raw egg.
That is a terrifying mental image.
Right. Like, it might be incredibly fast, but it could also just explode and leave you with absolutely nothing to show for it. Index funds are the slow cooker.
That is exactly the dynamic, which is why financial advisors universally tell W-2 employees to sell their restricted stock units, their RSUs, the moment they vest.
You don't want your net worth tied up in the exact same company that pays your salary. If the company tanks, you lose your portfolio and your job on the exact same day.
The sources highlight a massive, highly debated caveat to this rule, the Tesla and NVIDIA exception.
Ah, yes, the rocket ship dilemma.
Right. If your company is on a historic structural boom trajectory like NVIDIA during this recent AI explosion, blindly selling your RSUs for the sake of diversification actually caps your upside.
Holding that concentrated equity is one of the very few ways regular employees ever create nine-figure wealth. It's a massive risk, obviously, but the math occasionally justifies breaking the rules.
It does. And moving over to fixed income investing in taxable accounts, the playbook heavily pushes municipal bonds.
To avoid tax drag, right, because they are tax-free at the federal level.
Exactly. People look at a corporate bond paying 6% and a muni bond paying 4%, and they assume the corporate one is better. But you have to calculate the tax equivalent yield.
Because if you're in a high tax bracket, say 40% combined state and federal, that 6% corporate bond loses nearly half its yield to taxes.
Leaving you with roughly 3.6%, while the 4% tax-free muni bond is mathematically putting more actual dollars in your pocket.
Right. Okay, so we've covered the optimized W-2 strategies. Now we cross over.
Oh, yeah, we are entering the realm of the ultra-wealthy now.
This is session 4, the advanced tax erasers. This is where we stop just managing money and start actively erasing massive tax liabilities using real estate and weaponized charity.
The numbers here get staggering.
They really do. The sources lay out this aggressive real estate play using a hypothetical pro athlete or an artist earning $2 million a year. They live on the absolute minimum, and they invest the remaining $1.6 million into commercial real estate.
But they use leverage. They don't buy a $1.6 million property. They take that cash to a bank, use it as equity, and buy a $4.8 million apartment complex.
And the mechanism that erases their tax bill here is called accelerated depreciation.
Right. Through a cost segregation study, the IRS doesn't just see a single $4.8 million building that degrades slowly over 39 years.
No, you hire an engineering firm, and they separate it into components. The roof, the HVAC, carpeting, appliances, and they put those components on 5-year, 7-year depreciation schedules.
And by using accelerated depreciation, you can claim a massive percentage of those paper losses in year one. You might generate $2.4 million in paper losses immediately.
This is the magic trick. You earn $2 million in highly taxed active income, but your real estate is showing the IRS a $2.4 million depreciation loss.
So the paper loss completely offsets the active income.
Your tax bill is literally zero, even though the property is probably appreciating in value and throwing off like $90K a year in passive cash flow.
Which is taxed at a much lower rate, usually around 19%.
But wait, so what does this all mean for daily life? Fast forward 10 years. That real estate is worth $100 million. The wealthy never sell, right? Because that would trigger massive capital gains.
Never. They execute a strategy known as buy, borrow, die.
Borrow, never sell.
Yeah.
Okay, so can someone actually just borrow against an asset forever to fund their lifestyle tax-free? What if the market completely tanks and the bank comes knocking?
Well, the leverage is usually low enough to weather a downturn. They might borrow 60 million against that 100 million portfolio. Loan proceeds are not taxable income.
Right, you put 40 or 50 million in your pocket completely tax-free. This is how CEOs like Mark Zuckerberg can take a $1 salary.
Exactly. But eventually you die. And the mechanism that makes this entirely functional for the next generation is the step up in basis.
This is the craziest part to me. When you die and leave that portfolio to your heirs, the IRS just resets the cost basis of the property to its current market value on the day of your death.
Completely erased. If you had 90 million in untaxed capital gains, it just vanishes. The heirs can sell a portion of the property entirely tax-free, pay off the bank loan, and keep the rest.
That is wild. And a more grounded version of this for, say, a doctor is simply buying the physical building their medical practice operates in to capture that year one depreciation.
It scales down beautifully. And the same structural efficiency applies to philanthropy.
Oh, weaponized charity. Using donor-advised funds, or DAVEs.
Right. Because of that high standard deduction we talked about earlier, if you give $12,000 a year to charity, you might not get any tax break at all.
So instead, you use a mechanism called bunching. You take 3 years of donations, $36,000, and you dump it all into a donor-advised fund in one single year.
That rockets you past the standard deduction, capturing a massive write-off. And then you distribute the money from the DF to the actual charities slowly over the next 3 years.
But you don't donate cash.
Never donate.
You donate stock that you bought for $10 that's now worth $100. You get the $100 deduction, and you completely avoid the capital gains tax.
So erase the tax, got the deduction, and the charity gets the full value. It's optimal.
Which brings us to our final section, small business tactics and the penalty trap. Because not everyone can buy a $4.8 million apartment complex.
No, but almost anyone can structure their side income like a business, provided they don't fall into the IRS's $15 billion trap we mentioned at the start.
Right, the 8% interest rate on estimated tax penalties. To avoid this, you have to follow the safe harbor rules.
You must pay either 90% of your expected current year taxes or 100% of last year's taxes in quarterly installments. Do that, and you are immune to the penalty.
Once that's safe, over 100 deductions open up, like the Augusta rule.
This one sounds entirely made up. You can rent your own home to your business for up to 14 days a year.
The business gets the tax deduction for the rent expense, and the income you receive is 100% tax-free to you. You are legally moving money from your taxable business into your personal pocket.
Just need a legitimate business purpose, like an annual board meeting. They also talk about hiring family.
Wait a second, so people are literally renting their living rooms to themselves and putting their toddlers on the payroll. That sounds like a fast track to an IRS audit.
You cannot put a toddler on the payroll. The work has to be legitimate and age appropriate. But you can absolutely pay a 16-year-old under $14,000 a year to manage your business's social media.
And thanks to their standard deduction, the income is tax-free to them, and it's a write-off for your business.
Exactly. And the final piece is entity structuring, switching from an LLC to an S-Corp.
Right, to avoid heavy self-employment taxes, which fund Social Security and Medicare. It saves you about 15.3% on the profits taken as shareholder distributions.
It all comes down to the container your money sits in.
So to summarize this incredibly dense playbook, we've traveled from the defensive basics of Treasury ETFs and umbrella insurance, navigated the stealth wealth of HSAs and Vega backdoor Roths,
And finally arrived at the billionaire strategies of accelerated depreciation and tax-free borrowing.
The major takeaway for you listening right now is that you don't need a $50 million NBA contract to use these tools. Whether it's maximizing a match, saving a medical receipt, or starting a side LLC, these mechanisms are accessible.
If you know the rules.
If you know the rules. But I want to leave you with one broader question to ponder. If this playbook becomes mainstream, and every high-income earner successfully uses these extreme depreciation and borrowing loopholes to shrink their tax bill to zero.
Will the government be forced to completely rewrite the tax code?
Exactly. Will they effectively pull the ladder up behind today's wealthy? Something to mull over while you're scanning your medical receipts into the cloud. Until next time, keep diving deep.